Good morning and welcome to this Wednesday, October 4th, 2023 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be with you here for the next 30 minutes or so as we try to dissect the market, see what's going on this morning, and get a look at yesterday's action and what that could mean as we go forward. I'm going to jump right in, take a look. We've got a lot to go over. Today, by the way, is also live trading room day at earningsbeats.com. So if you would like, love to have you. First, I want to just make sure that we've got this sharing. Hold on. Okay, there we go. So if you'd like to join the live trading room later today, we do have a free 30-day trial that you can sign up for at our website. You can go to earningsbeats.com and make sure you sign up. If you sign up for the 30-day trial, you get our next 5 live trading rooms because we do them every Wednesday. So you'll have 5 of them within the next 30 days. But today is going to be a pretty big one because we're going to take a look at live trading where when the market is actually teetering on what I would consider a good analogy might be like on the edge of a cliff. Normally, the market just doesn't hover here. We're normally either going to see an acceleration of selling to the downside, or we are likely to see a big recovery. It's probably, I'm going to say 80 to 85, maybe even 90% chance it's going to be one of those two. Very little chance based on history that we're just going to sit here. So today could be a really big day. Make sure you sign up for that 30-day trial if you want to join us. In the meantime, I'll go through some of the things that I saw from yesterday, what I'm looking for today to maybe signal, the market reversing or the market continuing to make its move to the downside, perhaps even accelerating. First, let's take a look at what happened yesterday. You can see the Dow Jones yesterday down 431 points. That was down 1.3%, getting very close, by the way, back to that late May low. S&P 500 down 1.4% nearly. That was 59 points, continuing to move way below that 4,300 level and now approaching some support in that upper 4,100s to low 4,200s area. NASDAQ 100 lost 272 points. That was down 1.83%. We had key areas in the NASDAQ 100 like semiconductors, like software, had bad days yesterday. And as a result, we saw the NASDAQ pulling back pretty substantially, but it was really across the board. Mid caps down 1.62%. IWM, small caps down 1.68%. Transports actually on a relative basis held up pretty well, dropping just a little bit more than 0.75%, but nothing has changed there. We continue to move lower. And I was talking yesterday about maybe we were starting to see a turn up in the PPO. Looks like that really is not happening. I said yesterday, it really didn't look that, maybe, searching for a little silver lining there that just never really has materialized. Transports continue to move lower. Utilities leading yesterday, but hey, about time, right? I mean, utilities absolutely getting crushed, dropping $10 on the XLU in just the last couple of weeks. And I mean, in following the utilities, they can move a little bit from time to time, but $10 in 2 weeks is about as big a move as you'll probably ever see in the XLU. But it has been coming down. I think the higher rates, the 10-year treasury yield, moving up closer and closer to 5%, I think is sending a lot of income-oriented investors away from utilities and more toward that guaranteed 10-year treasury yield rate. And so I think that's part of what's going on anyway in the mass exodus out of utilities. Meanwhile, toward the bottom or at the bottom yesterday among the sectors, and by the way, utilities was the only group that was higher yesterday. The other 10 were lower. Discretionary led those 10, dropping 2.4% or almost $4 back down to where it was just about a week and a half ago. Real estate also taking a big hit, though not as big as discretionary. Real estate down 1.82%, just continuing to drop. And I think a lot of this in real estate has to do with commercial real estate. And I also think that you've got a lot of small banks mid-sized banks. It seems like some of those that are subject to a lot of commercial real estate loans are also taking it on the chin. So my guess is when we start to hear about from earnings from these banks and from many of these real estate companies, I wouldn't be surprised if a lot of the chatter is about commercial real estate and the difficulties that we're seeing there. The recreational services group, as we look at the industry groups, worst performer, down 4.43%, just continuing to drop. This looks like a mirror image almost of what we've been seeing in the transportation area, including airlines. So these groups, which look so good back in the middle part of the summer, have really turned and are, I think, looking like maybe we're going to see another series of bad reports out of these groups. I mean, I don't know what else to expect after we've seen such huge drops. The recreational services index was well over 100, probably up to about 108 about 10 weeks ago. It's now at 78. That's down nearly 30% in just a little more than 2 months. So clearly a lot of things going on. We've seen the cruise lines also taking a big hit over the past couple of months. Aluminum down over 4% yesterday. The aluminum index continues. If you look at the trend line, connect the highs or connect the lows, clearly we continue to trend lower. And then finally, renewable energy. I don't know if there's too many groups out there worse than renewable energy over the last 10 weeks. This is a group that was trading up at 425, now down at 283. That's down 140 points, which is probably between 30 and 35% lower. Really bad couple of months for renewable energy. I would not be looking for any stellar reports coming out of that group. All right, moving on to the 10-year Treasury yield. So a lot of what's been happening is that traders have been spooked. I mean, what more can you say? That's where we were. We are down a little bit today, and I should mention futures are up slightly. We can go over, actually, I'll just read off to you where we are right now on the diamonds, which track the Dow Jones. The diamonds right now up 0.16%. We've got the spider up 0.24%. The QQQ up 0.38%. All of these were higher earlier this morning, but they were down considerably overnight. So we did get a flip from negative to positive, but now they seem to be losing their luster as we get closer to the open. IWM right now up 0.18%. So it closed at 171.14, currently now at 171.44. So those are your futures as we go through. Also, crude oil prices are dropping. This morning, we're down about 1.6%. So remember, crude oil was at $94 a barrel not that long ago, back below $88 a barrel this morning. So we have been pulling back there. And as I mentioned, 10-year Treasury yield right here, down about 6 basis points. And it has been dropping this morning, currently at 474. That's down 6.1 basis points from yesterday's close at 480. We remain in this uptrend on the 10-year Treasury yield. No doubt this is spooking the market, but we have spooked the market down below some key areas of support. One of those areas of support, as I mentioned, on the S&P, 4,300. Now, we hovered a little bit below 4,300, tried to get back up through 4,300, actually 4,305, couldn't do it. And then yesterday took another sizable move to the downside on the S&P. And here's the chart to show you what I'm talking about. So here's where we went down, got just below, well, we tested 4,300, tried to bounce off of it, then went just below for about 2 or 3 days, kind of sat around 4,300, a little bit above the 4,305 level, also a little bit below. All of the closes were below 4,305 though. And then yesterday we accelerate again to the downside. Short-term picture, no doubt, is bearish. I mean, we've got some signals saying, hey, watch for a possible rebound because of like the equity only put call ratio. But if we're strictly with blinders on looking at the tactical price action, there's not a whole lot of good things to say right now about the S&P 500. So we can look at the longer term support levels, not 4,305, but maybe 4,200, possibly even slightly below 4,200. Then we can go all the way back to these lows that we hit back in April and May when we first started that big move up off the March low. That came in at about 4,100, or actually 4,050. So, I mean, there are multiple levels we can talk about, but when we start stretching out the charts to the weekly and to the monthly, I think this upper 4,100 area is pretty important. And we're sitting at 42.29. So here is the daily chart, PPO pointing down. We've got price action below the 20, below the 50, and we closed at a new low yesterday. It's hard to get excited by simply looking at the daily chart on the S&P 500. Now, if we stretch it out, let's go out to the weekly. The weekly, you've got the 50-week moving average, which is currently at 41.66. So that gives us about another 60 points to the downside. Would it be bullish if intra-week we went down below 41.66, came back up, finished back up, say above 4,200, printed a hammer? Yeah, I would think that would be a really bullish looking candlestick on the weekly chart. And it could line up with some other things that we'll talk about later, or perhaps after 10 o'clock during the live trading room. But on a monthly basis, look at where we are. I mentioned this yesterday. When you go up in a secular bull market advance, a lot of times on the monthly chart, when you get what you think is a fairly significant pullback on a daily chart, it really just shows up as like a little blip on the radar testing the 20-month moving average as you go up. Only a few times, mostly during cyclical bear markets or very significant corrections, do you get down to the 50-month. I'm not saying we're not going down there. Don't know. Nobody knows. We're going to find out. But what I can tell you is that that 20-month moving average throughout this latest secular bull market does hold as support many times, and we are sitting almost right on it. 41.87 is your 20-month EMA. 41.66 is your 50-week EMA or 50-week SMA. So here you've got two really important levels from a longer term perspective that come together between about 41.66, 41.87. And then you've got the daily, which I talked about, somewhere around 4,200, where you've got a little support. So if we have a big breakdown intraday and then rally back, some sort of a capitulatory move, and we are able to hold all three of these key support areas, that would be something to pay attention to from a bullish perspective. That could be the capitulatory move that marks a pretty significant bottom. Let's keep moving on. NDX, NASDAQ 100, breaking down. This one has not broken below the 14.5 level. On a relative basis, the NASDAQ is holding up better than the S&P 500. And I got to tell you, that is one of the below the signals or below the surface signals that tells me that we should still be open to this being nothing more than a short-term ABC correction and perhaps a pretty big rally in the fourth quarter. Now, again, short-term price action has to turn first. We need to hold this level. The NASDAQ 100, this NDX chart, isn't going to look any better than the S&P 500 chart if we get a close today below 14.5. And I mean, the bears are in charge right now. So moving below 14,500, that would only be 65 points. That's a very real possibility and one that we need to watch today and see what happens if we do make that break. The IWM, I got to tell you, based on the way it has been trading, all of that beneath the surface strength that I was seeing on the IWM, I'm doing a lot of intermarket relationship intraday. That chart has changed. It is not bullish any longer. It was just honestly a bad call on the IWM to outperform. Could it still? Sure. I mean, anything can happen in the future, but it's given away all of that intraday relative strength that I had talked about. These last 3 days have been brutal on the IWM, and even on my intraday charts, they've broken down. So if I'm going to be, singing praises for the IWM when things are looking good, got to be real and tell you the IWM does not look good right now. 160 is obviously the big level. We can go out to that 5-year weekly chart, and I think you can pretty much see here was that pre-pandemic high right around 160. We gapped up, broke out, and never looked back until the bottom or close to the bottom of the cyclical bear market in 2022. The June low, 160. The September, October lows, 160. Clearly, 160 is your number on the IWM. So maybe the underperformance in the IWM based on what's happened the last few days, maybe it does continue. If the market stays weak, there's nothing keeping the IWM from seeing 160, but that is a major level on the IWM. Major. I mean, if I was going to take any significant chances on the IWM, it would be in the low 160s. All right, next up, transports. Transports just continue to move lower. Here we saw that PPO trying to turn up a little bit. I think with yesterday's move to the downside, we're back down to a new recent low. You can see that PPO reached -2 back in March when we hit the last bottom. Maybe that's where we're headed. If so, I don't know, maybe it's going to be this 14.5 level. If it doesn't hold 14.5, I mean, I really just don't see anything on the charts until you're back down near those lows in April, which would be down closer to 13.5. 13.5. Got a couple bottoms there. So transport's not looking that good. I do want to talk a little bit about earnings because guess what? We're about a week and a half away from earnings season kicking in. One of the first companies that'll be reporting is Commercial Metals. And I'm going to show you that as my chart of the day in 1 second. If you are interested in the chart of the day, go over to earningsbeats.com, both plural, earningsbeats.com. We're named because this as Earnings Beats because this is what we do. We try to track companies that are beating earnings. And not just earnings, but also revenues. These are companies that we put on our strong earnings chart list. These are companies that we track that we feel are probably the better stocks to trade in an uptrending market. Of course, right now we need an uptrending market. But anyway, go over to earningsbeats.com. If you want to learn more about what we do in the market, the absolute best way to do it is to scroll down, sign up for our EB Digest newsletter, name, email address, hit that subscribe. No credit card required. This is a free newsletter. We do it because we want to give back. We want to teach, want to educate. We know everybody can't afford our service. This will at least help start you on the path of technical analysis and some of the things that maybe we're a little unique. We look at a lot of the intermarket relationships pretty strongly in helping us call market bottoms, market tops. We look at sentiment, can talk to you a little bit about, making sure that you keep an eye on sentiment at all times. But anyway, make sure you sign up. It's a 3 times a week newsletter, Monday, Wednesday, Friday. And it's a pretty quick read, couple paragraphs in a chart, but check that out. And if you want to sign up for our service, you can start your 30-day no-cost trial, 30 days, no cost. This would be a great time to sign up because it gets you through the month of October and into the beginning of November. And it gets you all the way through until we are firmly implanted in one of the strongest, not one of the strongest, the strongest period of the market. So let us help you guide you through these next 30 days and then see where we are as we move into the first week or so of November. So make sure you check that out. Again, you do have to give credit card for that one. We have to have you set up in our system, and it does require a credit card, but you will not be charged until the end of your trial period. We'll remind you, we'll let you know. So we only want you to stay as a member, a paid member, if you are enjoying the service, and that's what you want. So let's move on. Let's talk a little bit about Commercial Metals. So here's Commercial Metals Company. They report, I believe, on Thursday of next week, which is actually one day before JP Morgan and some of the big banks report. I think Commercial Metals and maybe Delta Airlines maybe going to kind of start to try and kickstart the market a day early in terms of earnings next week. So this is on Thursday. But when I look at this chart and I connect the lows and the highs, there are a couple of the highs that went just above, but these are the exact same slope. So what I do is when I find lows that connect, then I'll grab that and I'll drag it up to see if I can get a channel. So then when I drag it up, you can see it pretty much matches the majority of these highs. The other alternative is I can connect the highs and then drag that down to try to find the lows. So channel lines, trend lines, I always say they're very subjective. Two people, I see sometimes trend lines drawn really sloppy, and I'm a little OCD. I can't take that. And so what I mean is, sometimes you'll see somebody go to draw a trend line and, it'll be something like this, and it's not connecting the points. I don't know. I mean, that level's not going to be the right level on a trend line if you're not even connecting the right points. But what are the right points? Are they the intraday low? Or are they closing prices? Because you can see the slope of that line changes with each of those changes that I make. I tend to go mostly with closing prices. So that will, so sometimes you see an intraday outside the channel. I'm not really worried about that. I mean, if that channel connects all the closes and there are no closes outside the channel, like right there, I can see a close. And so again, my OCD side that bugs me a little bit. I'd rather have a perfect channel, but I realize these channels aren't going to be exactly perfect. This is a pretty good one. So if you make a definitive break out of it to the downside, that probably means that this 3-year uptrend and this 3-year channel could be over for CMC. And we're sitting right on the channel line now, and we report earnings a week from tomorrow. So earnings are likely to matter. That could be a major catalyst here. It could be a situation where we're sitting on the trend line, the earnings are great, and we have a big gap up, and we stay right in the middle of this channel as we continue higher. Obviously, the flip side is we could have a disappointing report, maybe disappointing guidance, and have a gap down that completely destroys this long-term channel. So CMC is at a pretty key level. I took these black arrows right here and I marked the recent highs because it's like a double or triple top on CMC, which means your lows in between these tops are really important. Those lows come all the way down here to about 42.50, maybe even 42. So if we do gap down, we lose the channel, which obviously would be a big negative. Maybe the channel is just not what we need to focus on. Maybe it'll be just an uptrend followed by a period of sideways consolidation with the tops at 57.5 and the bottoms down around 42, marking your key levels. So, technical analysis, it's really in the eyes of the beholders when you look at, these various things. Some might look at this channel and see a gap down as a very significant breakdown. Others who maybe are only looking at a 1-year chart might only see these lows and say, well, we're still sitting in the middle of this range. Or maybe what they do is they'll look at maybe a weekly chart and they're just looking at a double top and a bottom within an uptrend. Or not really looking very good here, but maybe they would look at that as a cup and this is a handle. But pure technical analysis would say the handle doesn't come down more than 50% of the cup. That would be kind of a weird cup if the handle comes all the way down the bottom of the cup or even close to the bottom. So I think already we've probably lost too much ground to call this cup and handle. But you can just see the different chart you're looking at will maybe, visually you might see different things. Looking at this, I would say, hey, we get up to about 42.5, 43 right in here. We broke out above it and we came back down, and on a weekly basis, we're holding that $43 level. So all of a sudden, we're not worried, we've lost the moving averages. Maybe we're thinking we're going to go back down to about 43, right? I don't know. Anyway, you can look at a chart a lot of different ways. Just beware. CMC has been a pretty big, pretty good company in terms of its performance. If we look at the relative chart, you'll see that over time, it's been a decent performer, or had been a decent performer versus steel. But over the course of the last month, it has lost a lot of relative strength. Is that a signal that maybe we should expect not so good results? Maybe. I mean, I don't know. I think holding any stock into its earnings report's a big crapshoot. You're rolling the dice. I think you have some things that make you feel a little bit better, that numbers are going to be good. This is not one of them. When I see a stock underperforming its peer group, I don't think very bullish thoughts. Now, the flip side is that steel over the long term, I mean, if we go back, with this chart 5 years, you'll see that steel has been outperforming the S&P really since back at the beginning of 2021, when we've had, that's basically when the inflation started. Steel prices started moving up. Many steel companies did well, and we've continued to outperform. If we're beginning to see inflation settle down. I mean, we've seen signs of it for sure. Maybe that's the end of the run for a lot of these steel stocks. This quarterly report next Thursday could be a big report, just, thinking about that. All right, we've got about 4 or 5 minutes left. And so I wanted to go over first the VIX and the VXN, because volatility index is something that's really crucial, especially when you're in an uptrend and you're making a breakout. Now, if you look back on the VIX, when you see the big spikes in the VIX right here, big move up very quickly, S&P, big drop. May, big move up, big drop. Big move up. Yeah, no, I wouldn't say a big drop, but pretty big drop. There was the big move with the pandemic. Now, I'm not expecting anything like that. That was when, folks were afraid we were going to have Great Depression 2.0. It was also a healthcare scare. People were, afraid to go outside to see anybody. I mean, there was a lot of reasons for fear there, both financial, at least at the beginning, and from a healthcare perspective. But that huge run up in the VIX sent the S&P down. I mean, if you look at the spike here down, we can go across the board. Look here, we spike up, got up to above 30, and we ended up going back down, I don't know, maybe 250 points. Here, big move, and you can see big move down. Here, big move down. My point is they move opposite one another. And the thing is, when you get a breakout on the VIX, you've got to be prepared for the potential of accelerated selling. And so that's kind of where I am right now, because the VIX, this 20 level is pretty important. And what I've shown here on this chart at the bottom is a correlation coefficient. Now, right now, the VIX is going up, S&P is going down, and this correlation is at -1, which is where it usually is. So the VIX and the S&P are acting normal. I've talked in the past, and one signal to watch for sometimes is when the correlation, this is almost like a little EKG or something, but when you get this spike back up above the zero line or to the zero line, look what happens here. Back in May of 2019, we went above the zero line, the uptrend flipped. Here, beginning of January of 2020, went up a little bit higher, but then we eventually flipped. Here, September, beginning of September, that was the highest reading I'd ever seen. We got to 0.75, which is telling you the market's getting very fearful. At the same time, we're going higher and breaking out to all-time highs. What's going on? Well, the market had a pretty big drop. And I want to show you the significance of this. And I mean, you can call this in real time. Here was September 3rd, 2020. Here is what I talked about with the positive correlation between the VIX and the S&P at the moment that it was occurring. So you go down here, right when it was at 0.75. And I talked about you got to be very, very careful, extreme caution. And here we were on September, and there was the VIX, or excuse me, there was the correlation. Here was the S&P, and there was that VIX rising, showing that the market was growing more fearful. And what that tells me is that the market's not going to handle bad news. It's already fearful. Any bad news, the market's going to be in big trouble. And there you have it. Next 2 months went down quite a bit. I mean, that was probably a 10% drop, maybe a little more, before we ended up going back higher. So always watch for these signals as well. I mean, here, this one didn't really work too well. This one, almost right on that high. Here, right on these highs, right before a drop. This one didn't really get there. This one, actually, we were coming down when we got this signal, and we reversed up. And then here, almost pretty close to when I talked about the market. I think that was in the July 18th or 19th YouTube video. I mean, if you want to go back and look at it, it's right here. That was Your Daily 5 video. But that was July 19th. And again, if we go back and we look at the VIX on July 19th, well, this was just before. This might have been around July 10th. But this was one of the warning signs that started to tell us to be careful. Then we had a bunch of others creep up as well. But you can see these signals are pretty important to watch. The VXN is the same as the VIX, except it tracks the NASDAQ 100 volatility. And as you can see, it normally is higher than the VIX. If you go to the VIX and you look back at prior readings, the VIX can get down to 10, sometimes even to 9. But you can see over the last few years, 5 years, we've been down to about 12, 13. If you look at the VXN, the lows go down maybe to about 14, 15. And that's about as far as they go. Why? Because the NASDAQ is more volatile by nature than the S&P 500. But you can see here, if we shorten this to a 1-year chart, we had not broken above that 2375 level until, I mean, we're talking about going back the last, I don't know, all the way probably back in since April. And yesterday we did it. And so if we lose 14.5 on the NASDAQ 100 with the VIX at a 6-month high, 5-6-month high, that tells us that we are potentially set up for a very rapid decline. It may only be a day or two, or maybe 4 or 5 days, but things can accelerate. So you just want to be careful, whatever that means to you. It could be in cash. It could just be in ETFs. No leverage. I'd be very careful with leverage unless you see some sort of capitulation. It may just be staying away from individual stocks, or if you're in them, maybe covered calls. I mean, with the VIX and the VIXN going up, premiums are higher. So you might get a little bit more premium out of a covered call. Those are all possibilities if you start to see the market really make a breakdown, maybe this morning at some point, who knows? Anyway, that's it. I'm going to be back at 10 a.m. And we'll have a live trading, another live trading event. And I'm going to go over, I've updated my intraday signals. I already spilled the beans a little bit on the IWM, but I want to take a look at the SPY and the QQQ, and also the XLY versus the XLP, because they're giving us some pretty strong signals that I think we're going to all want to pay attention to. So I'm going to lead off with that, by the way, at 10 a.m. So if you're interested, come on in if you're already a member. And if you're not, remember, we have that 30-day free trial. We'd love to have you. And today's going to be a big day to really check the market out and see what's going on along with those other signals. So hopefully I'll see you in about 30 minutes. Let's take a quick look at what's going on here in the market. We got a little bit of movement to the upside. NASDAQ doing a little bit better than the others, up about 0.4%. Just be careful. I think we're teetering right now. The analogy for me is you're on a cliff. You got one leg up in the air, and it's like, are you going to fall over the cliff, or are you going to save yourself? If you save yourself, chances are this market's ready to rally back to the upside. But if that foot falls over the cliff, I think we're going the other direction. My point is, I don't think we just sit at this level. I think we're going to see something. I think there are going to be fireworks here over the next day, maybe a few days, heading up to the jobs report on Friday. Could be a crazy period here for the market. Be careful, stay safe out there. And I'll be back tomorrow for your next Trading Places Live, and back in about 25 minutes for trading, the trading room, live trading room that we do. Love to have you there. Make sure you click on the like button below, and also be sure to subscribe to our channel. Thank you all so much. Have a great day. Happy trading.